fundsupermart.com.
Hi James, what is your overall outlook on emerging markets fixed income this year? And where do you see the best opportunities in countries and sectors in this asset class?
We're generally positive on emerging market debt at the moment. We think one of the key themes which we'll be seeing over the next 12 months is that search for yields. And along with the high yield sector within fixed income, we see emerging markets as positive from that perspective. So generally positive across that. I think it's key to differentiate two different areas within emerging markets, the local currency emerging market sector and the hard currency emerging market sector. And the hard currency emerging market sector can really be seen as a spread asset class. That's the sector which we like in particular at the moment, given the theme of dollar strength that we expect, more broadly over the medium term. Now, with respect to certain individual countries and issuers within that market, we like some of the higher beta names at the moment. So, for example, Venezuela. We think with the change of governments there and after the Chavez, then we think that there's opportunities there. I think that from a natural resources perspective, that Venezuela is in a fantastic situation. And also from a debt sustainability, we don't think that there has any trouble from that perspective in terms of servicing the outstanding debt in dollars. So we're positive on that. Also positive on some of the smaller countries. So overweight in terms of the Dominican Republic and some of the smaller issuers, which are less widely held, less widely researched, but we think have positive attributes, and we can gain additional return from holding those countries. In addition to that, and finally, there's some local emerging market currencies as well. Although we believe in dollar strength over the medium term, we do think there is advantages to be had by investing in some local emerging market countries as well.
The search for yield is a popular investment theme in the current environment. How does emerging markets fixed income fit in?
We totally agree with that. We do think the search for yield is an extremely important theme and going to be one of the key drivers over the next 12 months. It has been a key driver over the past couple of years, and we think that theme will continue. Emerging markets is one of the sectors where you can have an additional pickup in yields over your standard fixed income type investments, for example, developed government bond markets or investment grade corporate credit markets. So that's one of the areas which we do like, and we think investors are going to be focused, targeted at areas which are able to give that elevated levels of yields. One of the risks which we do feel is more on longer duration emerging market debt, where there may be some risk with higher US Treasury yields providing some sort of headwind for emerging market debt.
What is the estimated dividend yield that we can expect from the asset class over the mid to longer term?
The current yield on emerging market debt is roughly around about 4.5%. Now that varies, over time, given market yields. But really, the yields on emerging market debt can be split up into two components. It can be split up into the spread components and the risk-free components. And the risk-free components are really driven by US Treasury yields. Now, we believe there's value in the spread at the moment, but there is some risk in terms of US Treasury yields. If the US economy does start to accelerate, and we believe there are some strong backdrops, strong drivers for that to happen. One in terms of the energy policy, secondly to do with the housing market, and thirdly the financial system. The banking sector, is one of the first in developed markets to be recapitalized. So, the banks are in better shape to lend to the economy, which will help drive economic growth. So there is some risk in terms of Treasury yields heading higher, which will provide some headwinds, to hard currency emerging market debt. So we prefer to actually invest in shorter term emerging market debt in dollars rather than longer term.
Are there any risks that investors should be aware of?
Well, really with emerging market debt, there's the credit risk. And also there's effectively the duration risk, and hard currency debt. And in local currency, there's also the currency risk as well. People have to be very wary on local emerging market debt in terms of currency risk. And you saw this happen back in the third quarter of 2011. where there was a significant amount of currency volatility there. And it came as a surprise, I think, to a number of different investors. Now, we believe, given the fundamentals in the US, that there's likely to be some dollar strength over the medium term, and that theme to continue. So with that, slightly cautious in terms of taking a broad exposure to local currency debt. We do believe there's some opportunities, individual countries, and when investors are looking at local currency debt, they shouldn't be looking at the market as overall, but focus on specific currencies to add value. In terms of risks on the hard currency side, and certainly duration, we think, is one of the major risks there. And just being very cognizant that changing yields on the US 10-year, on US Treasuries, can have a significant effect in terms of return on emerging market debt.
Why should investors be considering short duration bonds?
Really, mostly due to those characteristics I mentioned in terms of, very little yield give up in terms of going from a broad sectoral of emerging market debt down to that 3 to 5 year bands. They're great roll down characteristics from the 3 to 5 year sector down into the 1 to 3 year sector. Also, in addition to that, the actual characteristics of the underlying issuance is somewhat different in the 3 to 5 year sector compared to the broader universe. So you're getting a little bit more exposure there to some of the higher beta names where we think there's actually more opportunity, for spread tightening. So I mentioned we liked Venezuela earlier on. That's one of the issuers which was slightly overweight. The index is slightly overweight in the 3 to 5 year sector compared to the broader universe. So it's a slightly greater weight, and we think that's an issue which has got more attractive return potential going forward into the future.
Can you briefly elaborate on the current positioning of the fund and why?
Within the funds itself, there are, I'd say, 3 different aspects there, which themes which we're playing on at the moment. One, being more exposed to some of the smaller issuers which are less researched. As one example there is the Dominican Republic. That's an issue which we've done a lot of work on. It's a smaller issue. It's not significantly owned or researched, and we believe it offers attractive yields given the underlying characteristics. Also, on some of the larger names which are trading at relatively higher yields, higher spreads, and one of those was, for example, Venezuela. We believe that, from a debt sustainability perspective, that's in a very good situation. And although, there are political issues with that country, we don't think that's going to be a significant effect in terms of the dollar-denominated debt outstanding and, overweight in terms of that issuer. And finally, individual and very specific local emerging market countries. So taking advantage of where we see a currency appreciation versus the dollar, but that's again very specific to particular issuers and not the broad market as a whole.
Thank you, James.
Thank you.